Hi, I'm Pattu from freefincal. Today, let's talk about will including gold in the portfolio help? I was told that today is Akshaya Tritiya. I didn't know. I just did it by accident, so I'm just making this video also, therefore, by accident. Um, so many people ask and many people assume that having 5%, 10% uh, allocation to gold in the portfolio will help. I'm talking about a long term portfolio. I've talked about how risky gold is for the long term in previous videos. And please recognize I'm not talking about accumulating gold for a future use. If you want to accumulate gold for a future use, either buy it physically and store it or buy sovereign gold bonds and use it. That's a risk-free way of accumulating gold. I'm talking about the tracking of gold price so that you can benefit from profit from the gain. I'm talking about that and probably from the risk. Let's see. So we will be looking at data from September 1996 to April 2020. We will compare the equity plus bonds, that is long-term bonds, long-term gilts plus gold portfolio with a 50% equity and 50% long-term gilts portfolio. This is the Benjamin Graham portfolio I talked about a few days ago. So we will be comparing a portfolio with gold with the Benjamin Graham portfolio, and we're going to increase the allocation to gold and see what effect it has got. Now we will use the Sensex for equity, we will use IBEX long-term gilt index for the gilts, and we will use gold from the World Gold Council for the gold price in INR. We will be using gold in INR. So the first graph, so I'm going to show you similar graphs like this. The first graph is the on the left hand side you have the XIRR difference for the portfolio in gold with gold minus Benjamin Graham XIRR. XIRR of portfolio with gold minus Benjamin Graham XIRR. We are looking at the 10-year SIP XIRR. We are going to look at 165 10-year data points from September 1996 to April 2020. Every dot there is a 10-year run. And what you see here is the excess return by including gold. So if this number is positive, it is an additional return. If the number is negative, it's a loss by including gold. And on the right side, you have the beta, that is the relative volatility. So if I include gold and the beta becomes 90%, then it means the volatility has gone down 10% by adding gold. If I include gold and the volatility, the beta becomes 110%, it means the portfolios become 10% more volatile. So you can see here that the first run or the first test is with 50% equity, 45% bonds and 5% gold minus the Benjamin Graham XIRR, and you can see for most of the time the returns are about there's not much of a difference, just 1%, a little bit less than that is about minus 1% or minus 0.5% kind of that kind of loss only. It's not much of a difference by including 5% gold. So don't add 5% gold, it's not going to be of any use. And you can see little bit the beta has come down. It's like 95, 98 kind of beta, 2%, 3% decrease in volatility. Now we're going to look at the same graph again and again, but we're going to increase the gold. Now this is with 15% gold. Notice that the beta is a lot more volatile. The up and down movement in beta, sometimes the beta can be more than 100%, but typically the beta is about 96, 97%. But you can see that the loss has become higher now. Most of the time it is still a loss. There's not particularly great benefit in including gold in the portfolio. The same thing is also valid for 20%. There's not particular benefit. Most of the time it has resulted in a loss when you look at historical data. I have other data for 25%, etc., in the post. You can have a look at that. So please do not include, there's no benefit, or I would put it that way. Instead of giving you a generic advice like that, I would say that the results for Indian data from September 1996 to April 2020 indicates that your Benjamin Graham portfolio of 50% equity and 50% stocks does much better than a portfolio with 5%, 10%, 15%, 20%, 25% gold There is no particular benefit of including gold in the portfolio. The risk is not significantly lowered or it is not increased so much, and most of the runs that we have seen, it has resulted in a decrease in returns. This is with annual rebalancing, and the costs of rebalancing has not been included. So there's no particular benefit in including gold. I think a simple 50-50 portfolio will work for pretty much every investor. That's what you should be focusing on. Of course, I'm not talking about gold-based investing and changing the equity portfolio with respect to time and all that. That you'll have to do personal on a personal level. This is with respect to a generic long-term investment portfolio. So that's what I want to say. Actually.